simple, easy, typical, but important concept. It's a mix of IAS 16 and IAS 40. It says that Carter Company vacated its head office building and let it out to a third party on 30th of June 2008. Now, when they tell us this thing that this company had this building before, and now they are, how to say, leaving it. So if you pay attention here, let me just see that it was its head office building. Then they are vacating it, and they leased it out. Let it out means give it to rent to someone on 30th June 2008. This means that before 30th June 2008, this was treated under IAS 16, which is called PPE. And PPE means that they should be doing depreciation before 2008. And when they leased it out, which means they rent it out, it became IAS 40 investment property. So this is the change in the standard which we are going to use. So during the full year, because we have to prepare how to say financial statements until 31st of December 2008. So it means that the first 6 months, like January to how to say June, it will be IAS 16. After it will be IAS 40. The building had an original cost of 900,000 on 1st January 2000. So you got it on 1st January 2000. Now it is 2008 and was being depreciated over 50 years. So 50 years. It was judged to have a fair value on 30th June as 950,000. So when you change the building from IAS 16 to IAS 40, you immediately change the valuation basis, because probably before, when it was IAS 16, when you were using the cost model, which means cost minus depreciation, and you were calculating the book value. But then when you converted it to IAS 40, you calculated the fair value, and the fair value was 950,000. And there is a possibility that there is a difference in the book value and the fair value. If the fair value is more or less, that we should find out. At the year-end date of 31st December 2008, the fair value of the building was estimated at 1.2 million. Now it is 1.2 million. Carter Company uses the fair value model for the investment property. What amount will be shown in revaluation surplus? Now, from this scenario, which they have given you, they're asking you one question. What amount will be shown in the revaluation surplus? Revaluation surplus. Actually, I could add 2 more questions to this particular scenario. First, let me find out what they're asking. They're asking you what will go to the revaluation surplus. Now, always remember, I actually put one additional video on your IAS, on your F7 page as well, a course page, a comparison of IAS 16 and IAS 40. If you have watched that video, you should be able to do this question. If you have not watched that video, I suggest that you must watch it. What you should remember, that when you make a revaluation, any change in the revaluation in your IAS 16, like if you have a PPE, property, plant and equipment, a building under IAS 16, and you revalue it, the revaluation, it goes to your, how to say, revaluation reserve account. It goes to OCI, other comprehensive income, and it goes to revaluation reserve account, revaluation surplus. But if you have an investment property, and investment property value goes up or goes down, that goes to profit and loss account, P&L. That goes to P&L. Now, Carter Company uses the fair value model for investment property. Let's now first find out what happens. Your purchase cost of the equipment of building was 900,000. Then do you people see Excel file? Yeah. Life of this asset.
Yes.
Life of the asset is 50 years. So I would say depreciation annual. Annual depreciation would be 900,000 divided by 50. 18,000 is going to be your annual depreciation. Now, if I want to find out net book value of the asset, I would say cost, which is, this 900,000. And then I would say accumulated depreciation for how many years? For 2000, 2001, 2002, 3, 4, 5, 6, 7, 8.
2.5 years.
9.5 years.
Yeah.
9.5 years until 30th of June 2008. There are 9.5 years because you start from 2000, not 2001. So 2000 is full year. 2000, 1, 2, 3, 4, 5, 6, 7, 8. This is 9 years. And until June, you get here 30th June. So 9.5 years I have. So this 18,000 multiplied by 9.5 into -1. This is your 9.5. I'm sorry, I need to put. So the book value on this date becomes 729. So I would say net book value at 30th 06 2008. 2001, 2, 3, 4, 5, 6, 7. It is 8.5 years, I think. I'm sorry.
It's only 53,000.
Yeah, it is 8.5 years. I made a mistake. 8.5 years, I should make it. 747. 747,000 is my book value, and revaluation on this particular date. And you revalued it. You did it on 30th June 2008. And when you did your revaluation on 30th June 2008, it is 950,000. So this is your gain on revaluation. which is 950 minus 747. It is 203,000. This is 203,000 gain on revaluation. This goes to revaluation surplus, okay, or revaluations. There is a slight difference in revaluation reserve and revaluation surplus. Actually, the account is revaluation reserve. The difference of change is called revaluation surplus, 203,000. Then what happens? You revalued again. You did a revaluation again. And when did you did it? When did you do it? You did it on 31st of December, 2008. And this time it is how much? It is 1.2 million. Now that's very interesting thing. So we would say that gain on fair value. So on 30th of June 2008, it is 950,000. On 31st of December 2008, it is 1.2 million. So if I see the difference, that difference is 250,000, and that goes to my P&L. Now, what do they ask you in question? What do they ask you in question? If they ask you in question, now they have asked us what would be shown in revaluation surplus. I know that the change in the fair value, this is fair value here, and this is fair value, because on this period, we called it IAS 40. Here it became IAS 40. So under IAS 40, if there is any change in the fair value, that should go to P&L. That should not go to revaluation surplus. Revaluation surplus will only go when it was revalued here from this point to this point, okay? When it was a tangible non-current asset of 747, you revalued it, you called it, no, it is 950. So this 203, this only goes to your revaluation. Your answer should be 203,000. 203,000. Are we clear on that?
Sir, my question was that the depreciation accumulated depreciation value, which is 1,53,000. Shouldn't we take it to P&L account?
Yes. Now that's the second question. Like I told you that we can make different questions from here. Let's suppose one question could be what goes to revaluation surplus. Okay. Like they ask you in question that what goes to revaluation surplus, answer is 203,000. Second could be how we should treat the change in fair value on 31st December. So that is 250,000, and that goes to P&L. And that goes to your, OCI or whatever. And the third question could be, how would this transaction impact the financial statements? That's the third scenario. Like overall, how this thing is going to impact. Now, this is an asset. And if I'm talking about now, they did not ask us. They only asked us this first thing. I'm just creating that what else they could have asked me. I mean, given the same condition, given the same data, what else they could have asked us? They could have asked us that what is the overall impact on the financial statement? So then what will happen? You would say that in P&L, what will go? P&L depreciation, 6 months for this particular year. Not all of the accumulated depreciation goes to P&L. In P&L, only 6 months depreciation. How much that would have been? 18,000 divided by 2. So 9,000 I would have charged depreciation. Then gain on fair value. This should go to my P&L, which is 250,000, and then my revaluation surplus, which is 203,000. This is like impact. The first 6 months depreciation. The first 6 months depreciation should go to P&L. This change in the fair value, you made a change in the fair value of 250,000. This should also go to P&L. So this is a cost. 9,000 is my cost. 250,000 is my gain. They go to P&L. But they did not ask us these two things. They only asked us what goes to revaluation surplus. Answer is 203,000. Are we clear on that?
So, but if we deduct that 1,53,000, because
no, 153 is your total depreciation for 8.5 years. In this year, you will only put 6 months. Remaining depreciation you already have posted in the last years.
Okay. Means I thought of taking 50,000 only to revaluation surplus. That is our
no. That's a different case. That's a different case. Like this 153,000 you have accumulated over a period of 8.5 years. Half a year, 6 months are pertinent or related to this year. 8 years are old. They are gone. So in this year, which is my 2008, in 2008, only 6 months depreciation will go to P&L. This is my cost. Okay. And this goes to P&L as my gain. And that goes to revaluation surplus.
Okay.
Yeah?
Got it. Yeah. Yes.
Good. Again, another simple, easy question from BPP Kit, question number 30. It says, whether by company purchased a machine on 1st July 2007 for $500,000, it is being depreciated on a straight line basis over its useful life of 10 years. Residual value is estimated at $20,000. On 1st January 2008, dates are always important, which means after 6 months. Following a change in legislation, whether by company fitted a safety guard to the machine. This safety guard cost $25,000 and has a useful life of 5 years with no residual value. Okay, so that is also part of the asset. You have to depreciate 25,000 over 5 years, 500,000 over 10 years with a residual value of 20,000. What amount will be charged to profit or loss for the year ended 31st March 2008? So it started from 1st July, 6 months in 2007, 3 months in 2008. So yeah, what is the difficulty? I don't see here. Let me say, wait a minute. Machine is one component and safety guard is another. You will ask the question, if you have any in terms of calculations. Okay, so 500,000 minus 20,000, I can call it 480,000. You have to depreciate 480,000 because 20,000 is residual value. Residual value you do not depreciate. So 480,000 divided by 10, and then you multiply it with 9 divided by 12. So 9 months depreciation. So equipment 480,000 from 1st of July to 31st of March. It is 9 by 12. If I take it here, it gives me 36,000. Safety guard I purchased for 20,000, 25,000, no residual value. 25,000 divided by 5 years, and we got it on 1st of January, February, March, 3 months depreciation, 3 divided by 12. So we take it here, 3 divided by 12, and it makes 1250, and you make a total 37,250. Is there any difference in the answer? Of course, safety guard is part. It is $25,000. It's a material thing, and it has a life of 5 years. Listen, generally speaking, what is a non-current asset? Tangible non-current asset, which will give you benefit for, which is a life longer than 1 year. Life longer than 1 year means you are going to use it for a period of more than 1 year, and it has, some substance, some value. So you depreciate it. I mean, that's clearly, it is a non-current asset. Either you install it on the machine or you buy it separately, but it must be depreciated. Listen, whatever money I spend, I have two options. Either I consider it as an expense in the income statement, which I call operating expense, or I call it my asset and take it to my balance sheet and depreciate. Only two options. In business, whenever you are spending money, there is no other thing. I mean, the third type of money going out is the dividend to the shareholders. For a business, when money goes out, either it is OPEX, which goes to income statement for 1 year, or it is CAPEX, which goes to the balance sheet for several years. This is not an OPEX. This is not 1 year expense. If they tell me that safety guard has only a life of 1 year, so 25,000 straight will go to the income statement. But safety guard has a life of 5 years. So you are not putting it as an expense for 1 year income statement. Income statement shows 1 year expense. Any expenses which is within 1 year. Safety guard has cost 25,000. I'm going to use it for 5 years. Annual expenses 5,000. 3 months expenses 1250. And yes, what happens sometimes, but that is not in F7. That wouldn't be an F7. But in real life, what will happen that sometime you might have some assets which you are going to use for several years, but you don't call them assets. I give you an example of wall clock. You set up an office, you purchase a wall clock for $30, for $40, and you know this wall clock maybe will remain on the wall for next 3 years. You are going to use it 2, 3, 4 years, maybe 5 years. Should I call it a non-current asset and start thinking about its life of 5 years and $50 wall clock start depreciating, $10 depreciation? This is a big fuss. It's extra hassle. It is called small value asset. I will charge this $50 straight to my operating expense, although it is an asset, but I will take it to the income statement as an expense because it is just $50. This is my God, $25,000. You have to take it as an asset and calculate depreciation. Okay. Now, this is one question. One of you have put it on the WhatsApp group. This is from your Kaplan kit. It's an interesting question. Let me first tell you that under IAS 16, which is your PPE, the cost of the asset, actually, you have to add cost, which means that purchase price plus installation cost, transportation cost, any other direct expenses. We have covered that in IAS 16 lecture, which types of cost we add. Apart from that, you also add your IAS 37. If you have any, how to say, restoration or decommissioning. Decommissioning means that you have to remove the asset, like, installation of the asset and uninstallation of the asset, or construction of some premises and, removing that construction and bringing it back to the original condition. We call it restoration. It is also included. I give you an example. Let's suppose that, there is a small place where they make some temporary shops, some market, some fair. So some event is happening and they make some temporary bazaar, temporary market, and people, they come and they make their stalls and they sell things for, let's suppose, 1 week time. And after 1 week, they have to remove their shop from there and keep it clean. So, when I have to make that small stall, it cost me $3,000 to make the stall. So $3,000 is my cost of the stall. Then I have to bring that stall to the location and fix it. I spent $500 on transporting the stall to the place. And after 1 week, I cannot leave the stall there. I have to clean that place and take my stall away. So I will again bring some people who will come and who will uninstall or who will decommission that stall or my small market shop, whatever you call it. They charge me $300 for uninstalling. And then I have to take it away, transport it away from there. And that cost me $200 further. So if you ask me, what is the cost of the stall? I would say 4,000 because, putting the stall there, it cost me 4,000. It includes the construction of the stall and the removal of the stall. Now here I'm talking very little numbers like 500, 3,200, etc. In real life, these numbers could be in millions. And you create IAS 37 provision, like 5 years later, 10 years later, you will spend some money. So you find out its present value. Because what happens that your construction happens today. Your construction, for example, let's suppose that you are building some some factory today, and you spend on construction of the factory 5 million. Okay, I'm just putting a number, just 5 million. So this 5 million, and then you know that you have to spend 1 million after 5 years time. After 5 years time. So this 1 million is also related to this asset, because you promised that I will remove the asset. If you don't make this promise, they will not allow you to make the asset. So in order to construct the asset and get benefit from this asset, you have to spend this. This 1,000 is also spent or promised to be spent in order to get permission for the asset. So get benefit from the asset. But this 1 million is not today. This 1 million is after 5 years. So you discount it. We'd find out its today's value. How much it is? Maybe it is 700. So we add it on the top. It goes to the cost of the asset. Okay. So IAS 16, cost of the asset includes IAS 37 provision, whatever you create. Then you also have IAS 23 borrowing cost. Let's suppose that you took some loan for the construction of a qualifying asset. Now, what is qualifying asset? You will study in IAS 23, but borrowing cost is the interest paid on the construction of assets which take relatively significantly significant period of time. So borrowing cost is also added. So this is like you are mixing three standards. Cost of the asset I'm taking, so IAS 16 I'm preparing the cost, IAS 37 I'm adding my provision for restoration or provision for decommissioning, and then I'm also adding my borrowing cost, interest cost for the construction of asset. So this is the topic. This question is related to the first two, the cost of the asset and the restoration cost. Now let me start reading the question and then I will do. It says on 1st July 2004, experimenter opened a chemical reprocessing plant. The plant was due to be active for 5 years, which means life is 5 years, until 30th June 2009, which is 5 years period finishing, when it would be decommissioned. So it would be decommissioned means it would be removed. At 1st July 2004, which means beginning of the period, the cost of decommissioning of the plant were estimated to be 4 million. So it's not exact, it's estimate, it's a provision, 4 million in 5 years time. Experimenter considers that a discount rate of 12% is appropriate for calculation of a present value, and the discount factor at 12% for 5 years is 0.567. Which means that if you have a life of the asset 5 years, you are going to spend 4 million here. Now, like I said, that this 4 million, we must discount it until here. And how do you discount? How do you find out? You would say that, decommissioning cost is 4 million. Let me write down all the zeros. Usually I don't write down all zeros, but for the sake of simplicity and convenience, let's put all zeros, 4 million. Now, present value of decommissioning cost. Because this cost you are going to incur after, this is after 5 years, okay? So what is the present value? They give you the factor 0.567. So which means 4 million times this one. Money loses value with time. So I would say that present value. Now, if you have seen my lecture on IAS 37, I have explained this process of all the double entries, how it would be recorded, how it would be. Momin, have you seen IAS 37 video?
Yes, yes, sir.
Okay. So now this actually, when you will calculate the cost of the asset, this 2.2 million will be added to the asset. Now, they did not ask you in the question. Let's suppose I would say that construction cost, let me just show you how it works. So they did not ask, but I'm just showing you the full picture. Decommissioning is this one. You add it on the top, and then this becomes the cost of the asset. This is your cost of the asset. And if they say that depreciation, if they say that life is 5 years, so life, let's suppose, is 5 years, then your depreciation would be this number, 12 million divided by 5. Okay, your depreciation will be calculated on this number. Always remember that cost of the asset, construction cost is 10 million. Decommissioning is 2.2 million. I added the present value, and 12.2 million I would say my asset, and then I would depreciate 12.2 million. This is how it is done. Now, in this question, what do they say? In this question, it says, what is the total charge? The word is total charge to the statement of profit or loss in respect of the decommissioning as at 30th June for 1 year. So what is in relation to decommissioning, which should go to the financial statements? See, in your profit and loss, you would write down related to, with reference to decommissioning, one thing will go the depreciation expense. And how much is that? Depreciation expense. Now, what is the depreciation related to decommissioning? This is your decommissioning. And the life is 5 years. So I would say double 2. Now, like my total depreciation is 2.4 million, but that 2.4 million includes the asset depreciation as well. Now, I'm not asking the total depreciation. They say charge related to decommissioning. So decommissioning element of the cost within my asset 12 million, or only 2 million was with reference to decommissioning. So I calculated the depreciation, which is related to decommissioning, 453,000. And the second thing which will come would be finance cost. If you remember IAS 36, that this your decommissioning cost, I would say, now, let me explain you so that you don't have to go to IAS 37. In fact, you should go, but let me make it very clear. Opening provision. Let me sum this topic up here. You have an opening provision for decommissioning. Opening provision is 2.2 million. Now, my friends, you create, what do you do? The double entry. For double entry of this thing was, the double entry for this thing was debit non-current asset, credit provision. How much is the amount? This is 2268. That's how I added this thing into my non-current asset. When I said that it must be added to the non-current asset, how will you add it? It's not you will mix two liquids. You have to make a double entry. First, you made double entry, debit, non-current asset, let's suppose 10 million. Then you said credit, bank, I don't know, when you construct the asset, 10 million. So 10 million is coming to the asset from this double entry. And then 2.2 million is also adding to the asset with reference to this double entry. So you have got 2.26 million added to the asset, 2.26 million on the provision. This is my liability. After 5 years, I have to remove. Now, your opening provision is 2.2 billion. If it remains 2.2 million in your balance sheet, after 5 years, how are you going to pay? Because you know, after 5 years, you have to pay 4 million. Whereas in your balance sheet, it looks like only 2.2 million. So you only pay what is in the balance sheet. If the balance sheet shows 2.2 million, you cannot pay 4 million after 5 years. This 2.2 million is my today's value. What I need to do, I need to inflate it. See, the process is like inflation, you know. First, you brought it the present value, you made it 2.2 million. And then you will start inflating it, unwinding it for 5 years so that it becomes 5 million. Now, how it will be done? What is the interest rate? They say that discount factor of 12%. It is given in the question. So I would say first year finance cost, which is 12%. I discounted with 12%. When you were discounting, it was done at 12%, okay? And now you will inflate again at 12%. You will increase it again at 12%. I'm going to add it here. See here, I would say 2.2 million into 12%. It is 272,000. You add it, and we call it closing provision. So end of year one, this will be called closing provision. This closing provision will be shown on your SOFP, okay? And this goes to your P&L. Now, this 2.540, you will keep on doing for the second year. Let me show it so that you become clear once and for all. Again, 12%. What I will do, 2.54 into 12%. I will add it. Then I will do it for my year 3. Again, for year 3, I will take this one, multiply, and I will add it. And then I will do my year 4. Then I will take it again, this one, and I will add it. And this is my 12% for year 5. And I will take it like this, and this one into 12%, and I will add it. And it becomes 4 million. Now it is 4 million, 3,996 something. That is the difference in rounding up. Every year. Now this will go to first year P&L. And let me just draw the lines so that it becomes clear to you. I just want to show you the full picture. This is my first year P&L and SOFP. This is my second year P&L and SOFP. And then it is my third year P&L and SOFP. So third year P&L interest cost will be this much. Fourth year P&L interest cost will be, I don't know, whatever it is. First year is 272. Let me just remove these zeros so that it becomes easy to understand here. So this is here. Then you will have this thing, and then you will have this thing. So every year, P&L will go to 304, then so on. But in year 1, the question asked what goes into year 1. So in year 1, how much is the interest cost goes to P&L? This goes as finance cost, 272,000. This also goes to P&L. So with reference to decommissioning, in your profit and loss, 2 things will go. One will be the depreciation, which is related to the decommissioning part, like 2.2 million divided by 5 years. And the second is the interest cost unwinding process, which is for 2 years. I just spent quite a lot of time on this thing, just in this hope that you understand it completely. 725,760 should be the answer. 2 elements, depreciation and finance cost. Are we clear on that?
Yes, sir. Yes. So here they added the provision standard.
Yeah, it is IAS 37 included. And every year, this will become closing provision at the end of year 1. This will be your closing provision at the end of year 2. This will be your closing provision end of year 3, closing provision end of year 4. This is closing provision end of year 5, and then you will pay out 4 million after 5 years. It will become 4 million. You see, we started with 2.2 million, and then we made it 4 million approximately, like 3966666 whatever. And the difference goes to every year profit and loss account, and this goes into your finance cost. In income statement, you have finance cost. It goes to finance cost.
Okay.